Hello. In this video, we'll be going over the costs that need to be capitalized for property, plant, and equipment. There are three main categories for long-term assets that are considered to be revenue producing. There are property, plant, and equipment, which is what this video is about. Natural resources, which there's a separate video for, and intangible assets, also a separate video. Let's discuss property, plant, and equipment. Property, plant, and equipment are long-term assets on the balance sheet that help a company produce revenues. They are land improvement, buildings, machinery used in the manufacturing, computers, office equipment, vehicles, furniture, and fixtures. Here's an example of Microsoft's financial notes disclosure for property, plant, and equipment. And you can see how they list out each main category of property, plant, and equipment. And this is their cost. And then they have one number for the cumulative depreciation on the entire amount to give you the net equipment. This is how it is presented in the notes to the financials for most companies. Let's talk about what costs need to be capitalized. But before we start that, what does capitalized mean? Capitalized means these are the costs that are going to be recorded on the balance sheet as a long-term asset. In this situation, it's a long-term asset. So when we say, oh, that cost needs to be capitalized, it means it needs to go on the balance sheet as an asset. Usually you're talking versus going as booking as an expense on the income statement. So if you have a repair, we say, oh, that's going to go on the income statement. If you have an extraordinary repair that would extend the life of an asset, we would say that repair needs to be capitalized, which we would add to the cost of the asset that it applies to. Okay, so now let's talk about the costs that need to be capitalized when we purchase a long-term asset. And let's just think of it as in terms of purchasing a machine. Well, the purchase price itself is going to be capitalized, plus any necessary expenses which means any necessary costs that are incurred in order to bring the asset to its desired location and condition for use. So meaning any costs incurred to bring the asset so it can be used for its intended purpose. The difference between what gets recorded as an expense versus what is capitalized has to do with the benefit from that cost. If the benefit from that incurring that cost is only for the current period, then we record it as an expense, such as a repair. If that cost gives you benefit for future periods, such as it would extend the life of the asset or extend the amount of time that we would be able to utilize that asset, then we would capitalize it. So once it's capitalized, right, on the balance sheet, then later as it's being utilized, it will be expensed into the income statement as depreciation expense. We're going to go through the different types of property, plants, and equipment and go through the most common types of costs that would be capitalized as part of that asset. So let's go through for equipment. The purchase price. Any purchase price you pay, but if you have discounts, that reduces the purchase price. Sales tax. We have to pay sales tax on our equipment. If we need to transport that equipment to get it to the place where it will be utilized, that's considered to be getting it ready for its intended use. If there's any sort of installation and testing necessary before that equipment can be used, those costs would be capitalized. Any legal fees to establish the title, and really any other cost for bringing the asset to its condition and location for use. So meaning for its intended use. And when you add all those items up, all those costs from all those items, that's the amount that needs to be recorded as an asset, aka capitalized in the balance sheet. Let's go through an example. Central Machine Tools purchased industrial equipment to be used in its manufacturing process. The purchase price was $62,000, so we're going to capitalize that. Central paid a freight company $1,000, so that's basically shipping to transport the equipment to its plant location, so that would be capitalized. Plus, they needed insurance for $300. That would be capitalized as well. In addition, the equipment had to be installed and mounted on a special platform built specifically for the equipment at a cost of $1,200. So let's look at this platform specifically for this equipment, meaning if you did not have that platform, then the equipment would not be able to be used. So therefore, that cost is capitalized. And then after installation, several trial runs were made to ensure proper operation, and the cost of these trials included wasted materials was $600. So all these costs are incurred in order to get the equipment ready for its intended use and in the proper location. So in this situation, even though the purchase price, right, of the equipment is $62,000, we're going to capitalize $65,100. Okay, let's discuss cost of land, the purchase price, any closing costs like attorney, title search, recording fees, the real estate agent commissions, any back taxes, liens, mortgages, or other obligations. The key here is back. If you pay taxes for the current year, after you purchase the land, then that benefits the current period, and that would just be expensed, okay? But if you pay back taxes, meaning the previous owner did not pay the taxes or liens or whatever it is, you must pay that in order to acquire the land, and those costs are considered to be necessary in order to get the land in place for its intended use, and those costs would be capitalized. And also specific to land, any sort of expenditures, which means costs that are needed to get the land ready, such as clearing, filling, draining, and removing old buildings. So sometimes, a company might buy a piece of land but already has an existing building on it. They're going to have to remove that building in order to get that land ready for its intended use, which would be to build a new building. And then so that all the costs associated with removing the old building would be capitalized as part of that cost of land. However, just note right here, it's a lot of red, that if proceeds from the sale of salvage materials after purchase reduce the cost of land. If you're able to sell any sort of materials from the anything that was on the land that you had to get rid of, such as buildings, if you were able to sell any of those materials and get money for it, that would reduce the cost of the land. Let's look at this example. Buffalo Metal Company purchased a 6-acre tract of land and an existing building for $500,000. The company plans to remove the old building and construct a new office building on the site. In addition to the purchase price, the company made the following expenditures at closing of the purchase. They have title insurance, that is going to be capitalized. Commissions is capitalized. Delinquent property taxes, and has an asterisk, which tells us that the property taxes included $4,000 of delinquent taxes paid by Buffalo on behalf of the seller, as well as $2,000 attributable to the portion of the current fiscal year that remains after the purchase. I don't think that this particular example does the best job kind of separating that the delinquent property taxes is actually 4, and then the current year is 2. I feel like this explanation makes it seem like part of the four. Of the four, 2,000 is for delinquent and 2,000 is for the current year, but that's not what it is saying. It's saying the full 4,000 is delinquent taxes, and then this 2,000 right here is the one that they're discussing is attributable to the current portion. So in total, this current year property tax does not benefit future benefits, does not benefit future periods. It is only for the current year. The delinquent property tax is needed to be paid in order to acquire the land and be able to use the land. So it is these three items that will be capitalized as part of the cost of the land, the 3,000, 16,000 plus 4,000. In addition, shortly after closing, Buffalo paid a contractor $10,000 to tear down the old building and remove it from the site. An additional $5,000 was paid to level the land. All these costs are part of getting the land ready for its intended use, and they should all be capitalized. So here's the total capitalized cost of this land. Is the original purchase price, the title insurance, commission, delinquent property tax, the cost of removing the old building, and the cost of leveling. And so the total is capitalized is $538,000. So the property tax is that total 6,000 minus 2,000 for the current period. Okay, land improvements. I should just mention back to land. Land is an asset that has an indefinite life and therefore does not get depreciated. And we'll go through more specific depreciation in the next chapter, but just know that land is not depreciated because it has an indefinite useful life. Land improvements do have useful lives that are estimable, and so therefore those costs will be depreciated over the periods that benefit by their use. But land improvements are separate from land, okay? They're not land, they are what things that the land can be used for. So you can build parking lots, driveways, private roads, you can build fences, lawn and garden sprinkler systems in the land. And so those are all examples of land improvements that have a definite useful life. There's a finite amount of time that those assets will be used for. Okay, cost of a building. The cost of a building is the purchase price, the realtor commissions and legal fees, and the reconditioning costs, which are refurbishing, remodeling, or any sort of cost that is incurred to modify the building to suit the needs of the new owners. So let's just say Starbucks buys a building and they have to rip out everything inside. That would be part of the cost of the building. If they had to put in new flooring or change the plumbing, because they want a bathroom instead of the left side where it originally is to the right side where they feel is better suited for this particular Starbucks, that's all part of the cost of the building. Now, when Starbucks inputs their machinery and their countertops and shelves, those would all be considered separately. Those would be capitalized under equipment or furnitures and fixtures, et cetera, et cetera. This is just a nice slide that kind of summarizes all the different kinds of assets under property, plant, and equipment, a description of what they are, and what the typical acquisition costs are. So it's just kind of a nice reference slide.